Pop quiz. A company signs a formal loan agreement to buy equipment. Which account does that usually create? Accounts payable, notes payable, revenue, or equity? Lock in your answer. We will come back to it once you see how this works in real life. In this video, you will learn what notes payable are, how they differ from other liabilities, and how to record the key accounting events from start to finish. First, the big idea. A note payable is a formal written promise to repay money at a future date. Unlike a casual amount owed, it usually spells out the amount borrowed, the interest rate, and when payment is due. Think of it as a trade. The company receives cash now, and in return, it takes on a legal obligation. So when the note begins, cash comes in and liability goes up. Here is an example. A bakery needs a new industrial oven, but it does not want to pay the full price upfront. So it borrows $80,000 from a bank and signs a 4-year note with annual interest. The bakery could have used a credit card or asked a supplier for terms, but those options either carry higher interest or shorter repayment windows. A formal banknote gave them a fixed rate and 4 years to pay, making it the more predictable, manageable choice for a large purchase. At the start, the entry is straightforward. Cash increases because the business received money, and notes payable increases because the business now owes that amount in the future. On the balance sheet, both sides grow together. Now, let's fix a common mix-up. Notes payable and accounts payable are not the same. Accounts payable usually comes from routine purchases on credit, like buying supplies from a vendor. Notes payable are more formal, often involve lenders, and commonly include interest. For example, if a company receives debts from a supplier and pays next month, that is usually accounts payable. But if it signs a borrowing agreement with a bank to fund a bigger purchase, that becomes notes payable. So far, we have covered the definition and the difference from accounts payable. Want to lock this in? Your personalized practice test and flashcard set are all waiting for you. Tap the link and give yourself a quick check. Next comes interest. At year end, the company records the cost of borrowing. If the note carries 8% annual interest, the business recognizes interest expense for the year and reduces cash when that interest is paid. Here is the answer to the pop quiz. The correct choice is notes payable. The clue was the formal loan agreement. When a business signs an official borrowing contract, that usually creates a note payable, not accounts payable. Let us deepen this with a second case. A landscaping company borrows $24,000 to buy riding mowers, and the full principal plus interest is due at the end of 1 year. Same idea, different payment timing. Step by step, the pattern stays consistent. First, receive cash. Second, record the liability. Third, recognize interest over time. Fourth, when the note matures, remove the note payable and pay back the principal. That final payment reduces cash and clears the debt from the books. A common error is recording only the original borrowing and forgetting the interest. Another is labeling every amount owed as a note payable. Ask 2 questions. Is there a formal note? And is there interest or a stated due date in the agreement? Those clues help you classify it correctly. To recap, notes payable are formal borrowing obligations. They begin with cash in and a liability up. Then interest is recognized over time, and the principal is removed when it is repaid. Now that you've watched the video, let's see how much you remember. Head to the link in the description where you'll find Quizlet content made just for you.